I'm going to start with the most uncomfortable sentence I'll say all episode. If you own a Standard & Poor 500 index fund, the one that everyone calls safe and diversified, you may be far more exposed to a single theme, AI, than you realize. Here's the backdrop. Last week, Ray Dalio went on Bloomberg TV and said that AI is a bubble. Here are his words. All great technology change produces bubbles. Meanwhile, on the same stage, tech CEOs are slamming the table saying, the technology is real and there is no peak. Standard & Poor 500 just blew past 7,000 points for the first time ever. Nobody, not Ray Dalio, not the tech CEOs, not even me, can tell you when the music will stop. But the music will stop. And here's the thing, I'm not going to spend an episode trying to predict when it will stop, because it's not even relevant. There's a way to invest where the timing of the pop doesn't matter. There's a way to invest where the AI bubble isn't a threat, but an opportunity. And it's the message that I teach on this channel. By the end of this video, you'll understand why the herd are so exposed right now, and why discipline is what is going to protect you. I'm Violet Grünbaum. This is Money and Freedom. Let's dive in. First, let's kill the biggest myth about bubbles. Bubbles are not just that the prices went up by a lot. A bubble is when the price floats away from what the thing is actually worth. When the stock price gets really separated from the value inside the company, the intrinsic value. And telling those things apart is fundamental. It is driven by emotions, fear, greed, headlines. It's sometimes driven by facts, but often driven by emotions and fantasy. Value, intrinsic value, is something completely different. It is what a business is worth when you sit down and actually do the work and figure it out. When you figure out what it's actually producing, how much money it's making, how doable the mode is, if it's got good management, and how much money it is supposed to make in the future. Most people only look at the price. And when I say most people, I mean private investors. They never figure out what a company is worth. And that is why they get caught in a bubble. The technology in that bubble can be very real. The tech CEO do have a point about that. The internet was real. AI is real, of course. The bubble was never a lie about tech. It's an overexcitement that pushes price far above reality. When I look at this AI market, I'm not asking, is the price high? It is. But that's not the point. The question to answer is, what are these companies actually worth? And is anyone really checking that? Now, this AI bubble really is an echo of something that happened decades ago, the dot-com bubble. So let's rewind and look at that. The internet had been developing for years, but landed in everybody's home, lab, desk with the web browser. When Netscape went public in 1995, it broke all the rules. Prior to that, you were supposed to be profitable before you IPO'd. IPO stands for initial public offering, before you went on the stock exchange. But Netscape was losing money. And the excitement about the IPO of Netscape changed everything about the IPO. They were supposed to price at 14, but because there was so much hype and excitement, they doubled the price just a few days before to 28. And you know what then happened? On the first day of trading, they closed at 58. That valued a money-losing company at nearly $3 billion overnight. Now that is crazy. And does that remind you of something that is about to happen? The SpaceX IPO, which we will talk about in another video. That was the starting gun. NASDAQ doubled and then doubled again. By 1999, companies were literally just adding .com to their name and watching the stock price pop. No product, no customers in some cases, just a domain name and a dream. And a stock price that went up. Then came the part that nobody planned for and nobody wanted. The crash. Between early 2000 and late 2002, NASDAQ lost 80% of its value. That hurts. Trillions in paper money gone. Roughly half the .com companies that got funded vanished. They no longer exist. But here's an important point. What came out of that wreckage? Real companies, real opportunities. Amazon, Google, eBay, lots of companies that are very valuable today. Speculators got wiped out, but real investors made a lot of money. The bubble didn't kill the technology. It killed the hype, the speculation, but it also rewarded discipline. Let's fast forward to today. The trigger of what's happening now wasn't actually the invention of AI. It was when ChatGPT landed in everybody's laptop or phone. They gained 100 million users in just 2 months. That is actually extraordinary. It is the fastest consumer product adaptation that we've probably ever seen. And that is your Netscape moment. And just like in the 1990s, money showed up. Money followed the dream. In 2026, today, companies are spending a lot of money on AI infrastructure. That is for sure. Data centers, chips, power. It is changing the landscape. The technology is there for sure. But here's a question that's really, really important to answer. And that is, where's the return? Who's making money? According to Bain & Company, by 2030, they estimate that the AI industry will need around $2 trillion in annual revenue just to pay for the computer power it's building. That's a lot of money. They think they are roughly $800 billion short every single year. Let's look at OpenAI, the company behind ChatGPT. They are on track to lose around $14 billion this year. That's a lot of money to lose. And they have committed around $1.4 trillion, hello, to future computing deals. They have a lot of people using ChatGPT. Around 800 million people use ChatGPT every week, but only around 5% of them pay anything. And this is really important. We have to see a path, somehow see a path that they are becoming profitable. This is super important when you invest in companies. If we can't see that they will become profitable at any point, we cannot calculate what they are worth. A lot of the money right now in AI is moving around in loops. The same handful of companies, the chip makers, the cloud providers, the AI labs, are financing each other. They're buying from each other, they are supplying each other, they are investing in each other, they are making deals. So in one sense, it's the same money making the same loops. A chip maker spends millions investing into an AI company, and the AI company turns around and spends the same money on the chip maker. Guess what's going to happen if one of them goes bust? It's going to fall like a house of cards. Okay, back to the uncomfortable sentence from the start, where I said that if you're investing in Standard & Poor 500, you are really concentrated in AI. And most people don't know it. A small group of the mega stocks, the Magnificent Seven, NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla, now make up roughly a third of the entire Standard & Poor index. And if you take the 10 biggest companies in Standard & Poor 500, they actually make up 40%. And what does that mean? That means every time you invest $100 or $1,000 into the index, in an index fund, you are actually investing 40% of your money in those companies. NVIDIA alone is the most valuable company and the heaviest weight in the whole thing. So when you buy Standard & Poor 500, you are actually indirectly making a huge bet on NVIDIA. So if you think about it, actually, because most people think when they invest in Standard & Poor 500 that they're investing in 500 companies. But actually, they are heavily investing in a few companies, 10 companies. And most of those companies are really tied into AI. And the rest of the 490 companies, you are hardly investing in many of them. Standard and Poor 500 is a very concentrated bet. Now, I don't mind concentrated bet. I can invest in a very focused way, but I know what I'm investing in. I've calculated the worth of these companies. I've taken them through a checklist. I know all about the leadership, the products, what they're going to make in the future. I know what I'm invested in when I make a focused, concentrated investment. But are you doing that with those 10 companies? Most people are not. And that is the problem, my friend. Now, index investing could theoretically be a great way to invest if you are spreading your risk. Then it makes sense, but you are not. And here's the problem. When the stock price of these companies rise, the indexes are forced to buy more of them. The index funds are forced to buy more of these companies. So the bet becomes even more concentrated. And this bet is happening regardless of the value. Remember the difference between price and value? So when you're investing in the index fund, you are not actually investing according to the value, because a lot of people are investing in index fund, so they go up automatically. And that is the opposite of everything that I teach and believe in. The entire point of value investing is that you refuse to buy company at stupid prices. And then you wait. You'd like a discount. Margin of safety, as we also call it. In index investing, there is no discipline like that. So if you don't want to buy the hype and you don't want to blindly buy the indices, what do you actually do? The cure to all this is value investing. And what does this mean? It means that you have to take the companies through a checklist. And below this video or below this podcast, there is a link to a checklist that you can download. You have to pick a company that you can understand. If you don't understand the company, then it's very difficult to take it through a checklist. So that's like the step before you take any steps. Do you actually understand the company? And then you run it through a checklist. And this checklist has around 12 points. And it will ask things like, are they making any money? Is it a good leadership? Of course also. Is it a strong moat? Moat meaning what protects it from the competitors. We'll figure out, is there too much debt in this company? We'll figure out, of course, what is it actually worth? What is the value of the company? And then the discipline part of this is to buy the company when you have figured out that, one, it's a great company with a good management and a strong moat that is actually at a very reasonable price on the stock market, where there is a margin of safety. Margin of safety means that the stock price is below the value of the company, the intrinsic value that you have calculated. And then you can invest. Now, there is no magic pill in this. It's not like you know exactly when the stock prices will do that. Nobody does that. Nobody knows exactly when a stock price peaks or a stock price hits the bottom. So, of course, you can risk that you invest in something and you know it's a wonderful company, the price is fair, and still the stock price for a while goes lower. But if you are really disciplined about this way of investing, you will be fine. In most cases, you will actually see that the stock price will go up by a lot over some years. And what I often see is that people panic after, even 5 days of buying the stocks. And you need to give it a bit of time, of course. Now, what if you are saying, I don't have time for all this. I don't have time to take a company through a checklist. I don't have time to calculate what it's worth. And all of that, of course, I can teach you. I teach this stuff. Contact me if you want to know more. But let's say you don't have time. Well, there's actually another way to do this, even without the index funds. And that is, I call that what I just talked about is the qualitative way of being a value investor. And the other way is the quantitative way, meaning that you invest in a lot of companies following key ratios. You use a screener, you use key ratios. When you use the quantitative method, you actually don't need to calculate what it's worth or take it through a checklist. Some of the things that we screen the companies for will make sure that the price is fair and they do make money and they don't have too much debt and they are growing and so on. And I can teach you how to do that as well. If you want to learn more, hear more about the market and how to do all this, remember to follow this channel. That was it for today. Bye.